Ironically, it was the government itself that had helped make Wall Street skilled at securitizing riskier mortgage, specifically the Resolution Trust Corporation, including filing threats the RTC, one of white hundreds of billions of dollars worth of assets, everything from eight rise office buildings to vacant plots of land that it took from the SNLS. It was closing down, but if the securities could get a AA or triple A credit rating, investors like pension funds would be able to buy them even without the seals of approval. It was their hate rating. After all, that was required for them to hold the securities, not Fannie and Freddie's warranty. Even before the RTC, Wall Street had been experimenting with ways to make risky securities less risky by using, for instance, a letter of credit promising inventors payment in the event the cash flow from the asset wasn't enough. But the RCT allowed Wall Street to work on such credit enhancement. They were carried on a far broader scale. Over time, people come up with a spread of ways to do credit enhancements. You could get insurance from a third party about insurance say you could over collateralize the structure, meaning you put in more mortgage than were need to pay the investors so that there was extra in case something went wrong, or in this will come later. You call to a so-called seniors subordinated structure where the cash flows from the underlying mortgage were redirected so that the senior bonds got the money first. The very missing the risks for the investors who own those bonds. Credit MSMs helped compensate the ranking advance to rate some of the traits AAA, which in turn helped convince investors to buy them. The innovative techniques that they developed are now in the process of being used by private sector insurers. Was the way Michael Hudmack, the director of Hassen Sales, put in a lecture in it. Larry Fink obviously had never envisioned credit and Siemens by economists at the concerted American Enterprise Institute noted the attraction of this cemented uprise is that the sender debates Apple the investor with limited tax per risk of limited ability to understand the rights of their underlying loans. At last, Wall Street had securitization boosted its codes to on a large scale, and it didn't have to share a penny with the justices. There was a final key to the rise of the supreme business. The federal government was behind it, not in so many words, of course, and to be fair, It is highly unlikely that many people in government truly understood what they were unleashing. Thus, it was that early in his second term as president, Bill Clinton announced his national homeownership strategy. It had an explicit goal of raising the number of home homeowners by 8 million families over the next 6 years. We have a serious human obligation to try to reserve this threat, said Clinton, referring to the drop in the home ownership rate. Together, the administration advocate financing strategy fueled by creativity to help home buyers who lacked the cash to buy a home or the income to make the down payments. Creatively putting people who lacked cash into homes was precisely what the new Supreme companies purported to do, which also explained why the government had such a hard time cracking down on the Supreme companies, even has it become apparent that there was widespread wrongdoing. Ronald Arnold's company, Long Beach Martins, offer a case in point. A few years later, around some time Clinton was announcing his housing initiative. The Justice Department behind its whole probe. Investigators found that Long Beach brokers, most of them independent, were charging up to of the loan amount over a base price. The amount they charged was unrelated to the qualifications of the borrowers or the rights to the lender. According to the government, younger white males got the lowest rates, while older single African American women fared the worst. In September, the Assistant Attorney General Deborah Patrick and an African American himself announced uh, a settlement with Long Beach. Although Long Beach denied the government allegations, it agreed to pay $3 million into a fund that would do toward um, reimbursing borrowers who were allegedly overcharged. The Federal Trade Commission originally demanded half of Long Beach's net worth to settle the case, but Arnold had what Daurio calls a brilliant idea. The company offered to put $1 million toward parents' ship with community groups for customers' education. Patrick and the VTC went along. What the case mainly showed thought was how difficult it was for the government to crack down on companies that were offering credit to people who would otherwise never be able to own a home. On the one hand, the Clinton administration's explicit policy was to get millions more American families into homes. Men like Harnan were making that possible. On the other hand, making it possible for poorer people to buy homes was inevitably going to mean charging higher fees and interest, practices that banks view as disreputable were widely accepted in the subprime world. Cracking down too hard of the subprime companies might hurt their ability to make loans to their customer base, who were the exact some people the government was trying to help. Ultimately, this was a highly politicized gray area, difficult to police. It raised a difficult question about which practices were legitimate and which were not. The government dilemma was obvious in the statement Patrick released when he announced the settlement. We recognize that lenders understand the industry in ways that we don't, he said. That is why there is so much flexibility in the decree. Clearing up the gray required a willingness to tackle the hard question about what subprime lending was and what was the proper way to conduct it, but that willingness was always in short supply. But then and later, the change in interest rates also left Wall Street firms searching for a new product to sell. They had been making good, some saying mortgage became securities that were taken according to their interest rate or and prepayment risk. When rates had fallen, so many people refinanced that, that the risk edges of the mortgage-backed securities lost much of their value. Just in time comes this new product, bonds backed by subprime mortgage, caused by those credit and some cement for Wall Street. This new business present a perfect opportunity. Straight films called makes money selling and trading the mortgage-backed securities, but they could also make money by providing a workhouse line of credit so that the mortgage companies could make the loans in the first place, and they could make money by taking supreme specialists public. It quickly became a frenzy. Traditional harmony lenders like Associates Household and the Money Store saw their stock soar. Supreme funders got very rich. For instance, the Money Store, which had been started by Alan Turtleblood and become a household name after Signop Hall of Famer Phil Rizzuto to be its spokesman. When public by the spring, its stock had risen fivefold. First Union bought the Money Store. Turtelbaum's stake was estimated as there was also a proliferation of startups making mortgage finance for a brief moment has hot as internet companies. Dan Phillips, an ex-Marine who had been a loan officer at Beneficial, founded a company called First Plus Financial. The stock soared. Phillips, who once described old school bankers as a constant who make a Well, he began building a estate in North Dallas, complete with a pool house and lighted tennis court, according to the Dallas Morning News. Right around that time, Dan Quali joined the board of First Plus. There were plenty of others: First Alliance, City Casp, mm, Hames, and more. Steve Calder, who had been an executive at Long Beach, co-founded a company called New Century. Robert Dubridge, another Long Beach alum, founded Option One, which was bought by H&R Block. They were frequently entrepreneurs, grabbing for the brass rating. They didn't spend a lot of time worrying about crossing every T and dotting every A. As Paul Monder, the director of regularity compliance for the Mortgage Bankers Associations, told the American Banker, and it's a high risk, high return market. It's a stand to reason you will have flasher types who worry less about winning the roles. It wasn't just the Democratic administration that saw a reason to applaud the rise on subprime lending either. Conservatives were applauding too. For instance, in that some American Enterprise Institute paper, the authors touted the virtues of something called high loan to value lending, or that was industry jargon for loans with low or no down payments. Customer debt collected by the borrower home is effectively a sooner claim when his income backed by asset that would otherwise the protect from censure uh, by creditors if he were to file for by group, wrote the authors Charles Colomiris and Joseph Mason, because lending can rely on security for the bulk of its financing in products are more diversified and thus a more stable source of customer credit. They conclude lending is good for the American consumer and for the USA economy.